Well, bank earnings came out of the gate hot on Friday. JP Chase led the pack, boasting a 67% jump in profit from the year prior, boosted by the acquisition of First Republic. JP Morgan, along with Citigroup and Wells Fargo, collectively grew their loan books to pad revenue for the quarter. All three lifted forecasts for lending profits in the year ahead, signaling no anticipated shift in borrowing. Joining us with his outlook on the sector is Gerard Cassidy, RBC Capital Markets Managing Director. All right, Gerard, thanks for joining us. First off, let's get into the results. We had a set of numbers the end of last week. What's your overall takeaway from that, and what are you looking forward to from, say, the banks ahead, Bank of America, Morgan Stanley, Goldman, in the week ahead?
Sure. Thank you for having me on the program. And when you look at the results that came out on Friday, a couple of things jumped out to investors. First and foremost, even though the net interest margin came down slightly for a few of the banks, such as JP Morgan and Wells, it actually went up for Citigroup. The net interest income growth, which is the backbone of revenue for all these banks, was actually quite positive, especially on a year-over-year basis. So I know there's been quite a bit of fear about deposit rates moving higher. And as you saw this quarter with these bigger banks, that was under control. They did go higher, don't get us wrong, but it was under control. The other thing that struck us was that the companies saw loan growth. And so even though loan growth is slowing, they're still reporting loan growth, which of course affects the profitability, especially in the consumer businesses. JP Morgan Chase and Bank of America, who's going to report tomorrow, are the leading consumer banks in the United States. And JP Morgan Chase on Friday's return on equity in the consumer banking business was close to 35%. So it's been a very profitable period for the consumer banking business. And then lastly, credit. The credit picture remains strong. Wells did build up their loan loss reserves because of their exposure to commercial real estate, particularly in California. But overall, credit trends remain strong. They're normalizing, meaning credit losses are slowly moving higher, but it's coming off of a very low base.
Gerard, particularly for JP Morgan, as you mentioned, that return on equity, not just in the consumer business, but overall, was sort of eye-popping in comparison with some of the other banks. Has JP Morgan set the bar too high for the rest of the banks now that are going to be reporting this week?
Well, when we look at the return on equity for the consolidated company, you're right, it was quite high, and we need to pull out of there. There was the bargain purchase gain, as you might recall, when they bought First Republic. And what that tells you is they bought the bank at a discount to book value, which is why they had that gain. And when you pull that gain out, the return on equity still drops. But that being said, you're right. They still are a leader in the profitability for the banks. They set themselves apart from the group, which is why their valuation is the highest amongst the big banks, because they're most profitable. So we expect to see the profitability of Bank of America remain robust. Clearly, some of the bigger broker-dealers or investment banks, Morgan Stanley, Goldman Sachs, will be affected by market conditions more so than JP Morgan was. But you're right, JP Morgan has definitely differentiated itself. It's the most profitable of the biggest banks, but in doing so, it's also the most valuable or the most highly valued based on price to book or price to earnings multiples.
Let's talk about another big bank. So Goldman Sachs, in the past, typically it doesn't guide on earnings, but there's been some whispers about its numbers coming ahead of its results this week. Is there any cause for concern, or are you worried about anything in terms of Goldman's numbers this week?
What we're likely to see, and I like how you say whispers, it's kind of like from a loudspeaker, I think, in terms of the media coverage. But anyway, they're not going to be very good. The company is obviously being affected by market conditions, similar to the other, investment banks or universal banks such as Bank of America, Citi, and JP Morgan in terms of their trading results and investment banking results. We all know investment banking, as evidenced by Friday's numbers, is very weak, and that's Goldman's forte, as we know as well. But Goldman's got other challenges they're going to report in the quarter. They're going to write down a number of their investments. There's a belief that they may even write down some of the acquisitions that they've done recently, and Green Sky in particular, as they attempt to sell that company. So that's what's going to compound and make their numbers look far worse than their peers, is the number of write-downs that the company's likely to take this quarter, including some real estate write-downs. As we all know, in the office real estate markets around the country, prices have come down in some cases in markets like San Francisco or Los Angeles, New York. Prices have come down from Class B and C buildings quite materially. And so we expect to see tough core fundamental numbers for Goldman. But on top of that, we expect to see write-downs of different assets that they have on their books, and that will compound the problem for them.
Gerard, are David Solomon's days numbered as CEO of Goldman Sachs?
It's going to be interesting. He's certainly had a tough time of it lately. And I think if he can put together a plan that is very credible for after this quarter on how he's going to return the bank back to profitability, kind of bring it back to its roots, as well as having a strong wealth management business, and set the company on that path, that may enable him to be able to still be at the leadership role at Goldman Sachs. Now, if he's unable to really put together a strong plan for the second half of the year, his tenure there could be in trouble. It's so we'll have to see. It's really going to be based upon what he's able to deliver after this quarter and the outlook that he can give investors and his senior partners at his organization.
Gerard, I want to switch gears and ask about the regionals. And you cover sort of the so-called super regionals, right? The bigger regional banks. When you were talking about, how the biggest of the big banks are doing, how much of that is going to extend to the regionals, which obviously had been a more sort of challenged area coming out of the mini banking crisis, as it were, in the spring?
It's going to be interesting because you're right. The regional banks generally are not as diversified as our money center banks or universal banks. And certainly some of the smaller regional banks felt more deposit pressures than the bigger super regionals. And I think most regional banks really do not want to show any type of meaningful decline in deposits because of what happened with the banks that failed earlier this year. So they've been paying up for deposits by using certificates of deposit, or term funding as it's called. And so that's going to put pressure on their margins, probably more so than what we saw on Friday from the biggest banks. But once we get through this quarter and the fear of having any deposit declines fades, because we're further away from the March period where Silicon Valley and Signature banks failed, and of course in May when First Republic failed, I think there will be less pressure on the banks to have to pay up for deposits. Also, if the Fed reaches the terminal rate for Fed funds, historically what we have seen is that 3 to 6 months after that terminal rate is reached, deposit rates stop going up. So this will be a very tough quarter for margins and net interest income for the regionals, but we think that it becomes less difficult in the second half of the year. But you're right, the upward pressure on deposits for the regional banks will be evident by the decline in net interest margins that the market is expecting for these companies this week.
Gerard, I want to go back to one thing you said about the issues with regard to commercial real estate. Now, last week, McKinsey put out a report saying that the remote work shift is going to erase some $800 billion in value from office space by 2030. So which banks do you think are going to be hit hardest? Is it going to continue to be the regionals, the super regionals, or how much impact will it be to the big banks?
It's a good question because the work from home has certainly changed the dynamic of office space in this country. It would be interesting, though, to see how it plays out over a multi-year period. There are many companies we talk to that are bringing employees back 4 days a week. Certainly in the tech sector, it's not that way. But it's a fair statement that there's obviously going to be a decline in the amount of space needed for large companies. But what's interesting, and you probably have noticed this with some of the high-profile commercial real estate defaults, most of, if not all of these high-profile defaults, like Brookfield's handing back the keys, so to speak, on that big Los Angeles property earlier this year. The lenders on these properties are not the banks. It's the commercial mortgage-backed securities industry. So it's the shadow banking industry has the biggest exposure to these higher risk properties. Now, don't get me wrong, the banks have exposure, but many of those banks have exposure to properties that are not going to be as affected by the work from home shift because they just don't have as much office exposure, and they certainly don't have as much office exposure in our biggest cities where the pressure is most acute because of the commutes going into the cities being, let's say, an hour to an hour and a half. Also, unfortunately, the higher crime rates, et cetera. And so most of the banks are not in these big cities like San Francisco, New York, Los Angeles, Chicago. And so therefore, yes, they will have some challenges. We don't deny that. But it's not cataclysmic as some of the headlines make it out to be. And again, thus far, the really big problems have been absorbed or been hit to the shadow banking industry through the CMBS market and not the bank's balance sheets.
Gerard, thanks for this. We are going to obviously watch all these numbers very closely to see what they have to say about commercial real estate and everything else. Gerard Cassidy is RBC Capital Markets Managing Director. Thanks, Gerard.